Hi, Northern Co-op Meat Company. Thank you for joining us today for this annual superannuation presentation. My name's Travis Bailey, Senior Financial Advisor from Advice First. And our firm are the advisors who provide support and services to Northern Co-op members in relation to the AMP Staff Super Fund. Today, look, we would have loved to have been there to meet with you, to conduct one-on-ones or to provide education and our services. But obviously, due to restrictions, we're unable to get down to casino at this point in time. So we thought we'd run a webinar just for some information and education in relation to superannuation, regardless of whether you're in the AMP fund or you have your own super. This is a presentation for everybody. So what I'll do is I'm just going to share my screen, but before I do, at the end of the presentation, in the coming week or so, we're going to be sending out an invitation for anybody that's got any questions or would like to go ahead and book a one-on-one with us to go ahead and make a booking. Unfortunately, we can't take questions in this format, but if you do have any queries in relation to your superannuation or any other financial matters, please give us a call. So I'll be sharing our contact details at the end of the presentation as well, but also for you to look out for the invitation. So I'm just going to share my screen and we'll take you through the agenda. So today's agenda, well, firstly, before we jump into that, just letting you know that today's webinar is of a general nature and doesn't take into account your own personal circumstances. Like I said, if you wish to talk to us about your own personal circumstances, feel free to book in a one-on-one with us. Today's agenda, we'll talk about who Advice First are quickly if you've never met us before. We'll talk about what things to think about in retirement. Also, some simulators that I've prepared for you to be able to access, for you to look at how to track your how your superannuation is tracking for your retirement. Tips on growing your superannuation by making concessional or non-concessional contributions, which I'll explain. Getting the most out of your superannuation, so some features and benefits of the AMP Staff Super Fund for Northern Co-op. And also we've got some additional material that's going to help you further engage and educate yourself in relation to your super and also topics outside of the super environment as well. So firstly, who are Advice First? Look, we're a privately owned financial planning firm. We've been providing financial planning advice to Northern Co-op and its employees for longer than 10 years. We specialise in advice and education, and we've been doing that for about 41 years. And the good thing is that we are Gold Coast based, so we're just across the border from yourselves, and we service private clients, so people that come to see us for personal financial planning advice, commercial clients, and corporate clients on a international and a national level as well. So we do also get to catch up with clients interstate and remotely. We have 9 qualified practitioners who specialise in specific areas of advice. And I guess the benefit of having a firm that provides 9 qualified practitioners is if you do come to us and you are after some holistic or private client advice, we get to align you with an advisor that we think is going to be best suited to you and also your needs. We're also supported by our incredible administration team. And also we pride ourselves on the retention rate that we have when providing advice to our corporate clients. It just shows you that we, once you're a client of ours, we go ahead and deliver and build a great relationship with you. So something that, yeah, we're very proud of. So let's talk about your retirement. So when you're thinking about retirement, the main question that we receive is, well, how much is enough? And it's obviously it's a question that is determined based on a number of different factors. So the amount you need for retirement can depend on how you want to live. You know, what does your lifestyle look like within retirement? Are you going to be staying within Australia? Obviously, we can't travel overseas just yet, but obviously factoring in whether you're going to be taking in travel overseas or whether you've got family in other countries or other states, or depending on what your hobbies are as well throughout retirement. as well. How long you will live is obviously a very important factor. I'll talk about some statistics based on, you know, how long we used to live in retirement over, say, 100 years ago compared to now, and how long we actually are in our retirement phase. And also where you live has an impact in relation to your lifestyle and obviously your cost of living as well. So we'll talk about those factors. But to be able to determine how much superannuation you actually need in retirement, it's when we sit down with clients and run simulations, we have access to some really great software. But I guess in the initial stages of meeting, it's nice to have people engaged and for them to actually go ahead and find out themselves, roughly based on their circumstances, what projection their super is going to accumulate to. So we've got a retirement simulator here that's provided by AMP, and I'll take you through that simulation online. We'll do an online simulation for that. And down the bottom, I've got the website for you to go ahead and access that. And then also on the right-hand side here, we've got another superannuation calculator, which is run through Money Smart. So the website is there as well, just to give you a bit of a variety there. So what I'll do is I'm just going to stop sharing my screen and we'll just jump into the simulators themselves. So this is the AMP My Retirement Simulator. It's easy to navigate through and pretty self-explanatory. So what you do is obviously you log in through the browser and then you click on Let's Get Started. So it asks, let's find out a little bit about ourselves. I will use just a hypothetical scenario for this simulation. Let's say we're 38 years of age, and once you type, just click outside of that field. Do you plan to own a home outright by the time you retire? Well, let's say yes. It would be great to be able to have your mortgage paid off. Do you have a partner? Look, for the simplicity of this, let's say no, but based on the average cost of living, can go ahead and determine whether you're single or whether you're in a relationship and living with someone. So you can obviously adjust that depending on your circumstances. Let's have a look at your gender, male, my life expectancy. So you can see here it defaults to an average life expectancy for an Australian male is age 81. And then down below, it says here that I'd like to retire when I'm going to put when I'm, say, 60, let me put in 63 years of age. And I guess when it comes to your superannuation, your preservation age, or the age of when you're able to access your super, is age 60. So that's when we're able to access our super. The age pension age is when you're eligible to line up at Centrelink to obviously access any age pension, if you're eligible, is age 67. So 2 ages just to be familiar with. But let's say our retirement age is age 63 here. And then it goes on to asking you, so when you're in retirement, I think I'll need X per week in retirement. Now, I'm going to live a life where I will go ahead and obviously accommodate for paying for the everyday basics of living for a single person. But then I also want to perhaps go ahead and travel as well. So look, I'm going to put in an income of, let's say, $1,000 per week to live off of, especially in the early ages of retirement, because I'm wanting to do some travel. Would you like to include any one-off expenses as well? So that's like taking a holiday. I've already pretty much factored in my weekly income to accommodate for a holiday, but buying a new car, having some emergency expenses, you can put in yes if there is, but for this simulation, we'll say no. So Firstly, they need to calculate, they're going to accumulate, these simulators are going to accumulate how much you're going to accumulate in your super based on what your income is and also what your employer contributions are. So let's say that I'm on an income of $60,000 per year, and am I going to be taking any career breaks? No. How much do I have as a dollar figure worth of assets? And that's assets, and it says here excluding your home, because this will help calculate what the projected age pension entitlement would be when you actually reach age 67. So let me say I've got some contents, I've got a motor vehicle, and some savings in the bank, and some super. Look, let me say that I've got $220,000 worth of assets, and that's not including your home. And what is your current super balance? Look, at the age that I've selected, let me say I've accumulated, let's say $180,000 worth of super. So I'll click outside of that, view my results, it'll run a simulation. So it says your retirement super balance will be $418,205, and based on your desired lifestyle, it will last you to 74 years of age. Okay, so you can look at downloading your results, you can print this out, but when you scroll down, it'll have an illustration here. So you can see here, I've got retirement age, I selected age 63, and you can see here that my desired income in this color here is $52,000 per year, so $1,000 per week. And you can see here in the grey is your age pension as well. So in the initial first stages of retirement, you've accumulated money in superannuation, and you pretty much draw down your money out of your superannuation. You actually go and seek advice, and we actually convert your money into pension phase. So you'd be drawing down your superannuation through the pension phase, and that's illustrated in blue there. So you'd be taking out $52,000 per year up until around about age 67, and then your pension from your super reduces because the age pension, like I said, kicks in at age 67. So at that age, you would receive around about $3,591 worth of age pension, and the remaining $48,408 would be withdrawn out of your super as usually a fortnightly or a monthly income. As you transition through life, age 68, the age pension goes up as your super savings starts to diminish. But you can see here up until age 62 is pretty much when you're living off of the desired lifestyle income that you selected. You can see that once your superannuation runs out, you're then just left at age 73 on the age pension, which would be for a single person about $20,000 per year based on the amount of assets that I've disclosed. So what you can do is, with these illustrations and these simulations, you can scroll down and you can start to play with maybe making further contributions into your super. So let me say, let's make some contributions. Salary sacrifice, which I'll talk about a little bit later, but let's say we salary sacrifice $500 per fortnight into my super from now on. And you can make personal contributions, which are after tax contributions, not salary sacrifice. And there might be like a one-off contribution. I might receive, say, a $50,000 inheritance, maybe, in a few years' time, in say 10 years' time. So let's put those assumptions in. You can also look at your investment mix as well. I'm actually more of a growth investor, so I might change that from balanced to moderately aggressive. And in retirement, rather than being cautious, I'm going to be quite a balanced investor, and I'll talk a little bit more about that as well. But you can obviously change a few assumptions, apply the changes. You can see there that my super balance has increased due to my contributions and my shift in my investment strategy up to about $795,000, and that will last me until about age 82. Once again, you can see where you're drawing down your super, and then also in the grey where the age pension is starting to kick in as well. So quite a more sustainable outcome for that scenario. So look, I just wanted to run through that simulation, which is through the AMP website, and it's quite engaged. You've also got Money Smart. So if you went onto the Money Smart website, there's a whole lot of different calculators. You just click on the 3 lines there, and then you can go to super and retirement. And then you go down to super calculator, and then same sort of format is you can go ahead and include all your details. So look, I'll just leave those with you. I'll stop sharing my screen and I'll just come back to the presentation as well. All right. So once we've determined roughly what our super is going to be worth, and also how much extra contributions we need to make into our super, I guess, they are the questions you need to ask yourself. Are your employer superannuation contributions enough to meet your retirement goals? What are the options to grow your super, which I just showed you a couple of examples, whether it's making extra contributions or changing your investment risk profile within your super fund. And also, will the age pension, will that be enough to go ahead and support myself? You could see in the second scenario, I think it started to kick in at about age 79. And with those factors pulled together as how long is your super going to last you? And then also, how can I get advice? Obviously, you would come and speak to us if you're nearing retirement, and start obviously discussing, what solutions you should be putting in place and what's the best format and approach for yourself. So just looking at a comfortable retirement, research performed by the Australian Superannuation Fund Administration or Association, it shows that for a comfortable retirement, a single person may require a lump sum of about $545,000, and a couple may require a lump sum of about $640,000. So this is based on the average budget and living standards for those around age 65. It assumes that to live comfortably, a single person would spend around about $44,412 per year. For that scenario I used, I was factoring in, say an extra $8,000 per year. I chose $52,000 per year, which is $1,000 per week. So there was an extra $8,000 which was included in my weekly expenditure to allocate for, say, an $8,000 holiday, whether that be overseas or locally. For a couple, the standards say that a couple for just a comfortable retirement would need around about $62,828 per year. So look, there's a big change that's happened, I guess, since greater than 100 odd years ago. So back in 1909, the pension age was 65 for males, and about half of the male population only lived until age 65. And of those that reached age 65, the average time spent in retirement was only about 11 years. So if we now fast forward over, say, 112 years since 1909, now the expected average life expectancy of a male is age 80, and the average time spent in retirement is about 19 years. So we're spending about a quarter of our life nearly in retirement. So it's a lot different. We need to go ahead and plan and accumulate and have assets behind us to go ahead and provide us with that retirement. And even when we look at females are expected to live until age 85, so they need even further planning as well. So when it comes to growing your super, look, why do we save inside super? Well, superannuation is a is a retirement vehicle, and it's got some tax incentives as well. Whenever we invest in superannuation, you can see on the right-hand side, tax rate within super is taxed at 15%. So any tax on income earned within super is taxed at 15%. Whenever there's a contribution made from your employer, from Northern Co-op, into your super, it's taxed at 15%. And when it's in super, it's taxed at 15%. So just remember that. Where if you go ahead and depending on your marginal tax rate and obviously your income level, that then determines what your tax bracket would be. So between $0 and $18,200, you don't pay any tax. For $18,201 through to $45,000, you pay 19 cents in the dollar. And then obviously as the brackets start to increase, you can see what the cents per dollar per threshold is. So there are some people that might be on, say, $100,000 that might be in a tax bracket of, maybe, 30-odd%. So super can be quite an attractive investment for some. So when employers, when your employer contributes into your superannuation, it's placed into a portfolio, and that portfolio is there to provide returns over your accumulation timeframe of working. So when they invest your money in a portfolio, they invest it in asset classes, and I'll run through those asset classes for you. And depending on your asset class, there are some asset classes that take zero risk, but they also don't give as much return. And then obviously, as you start stepping up into more riskier investments, it has obviously more risk, but has the greater potential for greater return. So if you look at cash and fixed interest, also known as bonds, cash and fixed interest, they're classed as defensive assets. They take low levels of risk for obviously the result in low levels of return. Then you start moving into other asset classes such as property, infrastructure. Infrastructure is something like railroads, tollways, waterways, electricity, sewerage. Those infrastructure assets are also, they're classed as like a defensive and a growth asset. Then you start moving into alternative assets, which I won't go into, but you've also got shares, or also known as equities, where you're investing in a company in hope that that company goes ahead and earns a profit every year and provides income in the form of dividends, and also has capital growth in their share price every single year. So when you look at property, infrastructure, alternatives and shares, they are classified as growth assets. And those growth assets are also placed in your portfolios. So when we look at the portfolios, I guess within AMP, they use a glide path approach. So these are called default investment portfolios. When you first join AMP, or maybe your super provider, they may have the same form of format. But when you first join, depending on your age or your decade of birth, you will go into a portfolio that's already structured for you depending on your age and decade of birth. So if we look at this glide path here, the portfolios at the very bottom, you've got defensive assets in light blue and growth assets in dark blue. And let's say there's someone who's 23 years of age. You would see that if they were invested in this super portfolio, especially with AMP, they would have about 95% of their money invested in growth assets, which is shares, property, infrastructure, and alternatives. And then they've got about 5% of their money in defensive assets, such as cash and bonds. As you start to transition through your life, these portfolios will maintain their investments, and then they'll start to de-risk over time as well, as you're obviously nearing retirement. So when you get to, say, at the age of 42, 43, the portfolio is probably de-risked from, say, down to 90% of growth assets and 10% of defensive assets. And then once you get into your 50s, you'll find you've probably got about 70% of your money in growth assets, 30% in defensive assets. And by the time you get to, say, your mid-60s, you've got just over 50% of your money exposed to growth assets, just to go ahead and protect the amount of money that you've accumulated, due to protecting against any volatility that growth assets can go ahead and bring to your portfolio. But remembering as well that even when you get to age 65 or even pension age at age 67, you're probably going to live for maybe an extra 23 or maybe 30 years. It's not uncommon to see people living into their 90s or in the hundreds now. Imagine people of, say, even my generation, how long we're going to obviously be in retirement for because of our extension and our longevity of our life. When I talk about the portfolios, these are the default investment portfolios. So you will go into a portfolio like this if you don't elect your own portfolio. Within AMP, they have an investment menu outside of these portfolios that you're able to invest in. So you would seek advice from an advisor just to understand what the alternatives would be, and to see whether there's another portfolio that would be probably more suited to yourself. When we talk about contributing into super, obviously you've got employer contributions that are made. Your employer, Northern Co-op, pays 10% of your gross income into super. So that goes into super and is invested into your portfolio. You can also make additional contributions, like I showed in the simulation. You can make concessional contributions, which are also known as salary sacrifice contributions. So salary sacrifice, it's directing some of your pre-tax income into super, which can boost your retirement savings. So you can go ahead and nominate for a specific amount to be taken straight out of your salary before it's taxed, and it goes straight into super. And when it goes into super, remember, it gets taxed at that rate of tax of 15%. The money's invested in a highly tax-effective super environment. Like I said earlier, every bit of income is taxed at 15% as well. And earnings outside of super, like I said, if you were to invest money outside of super, you could be paying tax at a higher tax rate depending on your marginal tax rate. How do you start salary sacrificing? Like we've shown you, calculate how much your employer contributions, also known as SG contributions, will add up to for every financial year. And then think about how much you want to contribute from your future salary, maybe any bonuses you receive, some leave entitlements, or sometimes people can go ahead and put in, after tax, maybe a bonus. But we're talking about salary sacrifice contributions. You can look at, speaking to us just to determine roughly what would be a suitable amount and whether it's going to be tax effective enough for you to do that. When you're putting the agreement in place with your employer, you usually put it in writing to them. It's usually through your payroll officer to say, look, I'd like to set up a regular salary sacrifice plan to place some additional funds into your superannuation. I've got a quick example here. So a normal scenario, so someone who's on a salary of, say, $75,000, and the total tax paid on $75,000 is around about $15,262. So that's a tax rate of 20.35%. So that means your take-home pay would be around about $59,738. If you go to the right-hand side, based on a salary sacrifice scenario, someone who's on an income of $75,000, on the right-hand side, this person decides to salary sacrifice $5,000 over the financial year, and they take $70,000 as salary. When you look at tax on $70,000, you pay about $13,537. And then you look at tax on super. Remember, you pay 15% tax on your super, so that's $750. So combined would be $14,287, which is a tax rate of around about 19.05%, which is about a 1.3% saving in tax by obviously putting money into superannuation. So your take-home pay is around about $56,463. You have taken a little bit of a hit there, but for the benefit of adding some more money into your super on top of your employer contributions. So an additional $4,250 goes into super. So the net benefit when you're looking at comparing the tax entitlements there, really you're coming out with about $60,713 on top compared to $59,738. So nearly about $1,000 saving there as well. Usually salary sacrifice is more of an incentive for people earning above $56,000. If you're earning below $56,000, you're probably paying a lower rate of 15% tax. So probably not as much of a tax incentive, but still you can go ahead and put money into super after tax if you want to obviously start with that accumulation savings plan and compounding that over time. So not a bad example. Contributing into super after tax, like I mentioned, it's called a non-concessional contribution. So when we talk about your concessional caps, your employer contributions plus your salary sacrifice contributions, if you add both of those together, they can't exceed $27,500 in any financial year. Now, the legislation changed on that last at the budget in May. So it used to be $25,000 your cap. So now it's $27,500. Just make sure that you don't exceed that that cap amount. With your non-concessional contributions, so a non-concessional contribution is you might have saved some money in the bank account. You may have sold a house and had some excess surplus funds. You may have received an inheritance. Look, somewhere along the line, there's probably been tax already paid on the money that is sitting in your account. So that money you can go ahead and contribute into super. It's called a non-concessional or an after-tax contribution. And your cap, you're allowed to contribute up to $110,000 per financial year into your super as a non-concessional contribution. There are some carry and some bring forward rules. So for your concessional contributions, look, if you put in, say, $20,000 of combining your employer and your salary sacrifice contribution, let's say in one financial year you put in $20,000, it means that $7,500 wasn't used. You can carry that forward to next year. So that means your cap next year would be $27,500 plus an extra $7,500 that you can utilize. And you can carry forward that for 5 years and then it drops off. For non-concessional contributions, if you're under the age of 67, you're allowed to put in $110,000 per year, like I mentioned, but you may have gone ahead and sold a property and had some funds come in. You're allowed to go ahead and put in a lump sum of $330,000 in one lump sum, but you're not allowed to make any further contributions for another 3 years. So over the 3 years, you've pretty much accounted for $110,000 per year, but you can go ahead and do that lump sum, but no further contributions for 3 years. For non-concessional contributions for anyone who over the age of 67, unfortunately, you're restricted. You can't put in that larger lump sum of $330. You can only go ahead and put in $110,000. Look, if you're over the age at the moment, if you're over the age of if you're 65 or older and you've gone ahead and sold your residential property and downsized, there's also a strategy there and some legislation for people over the age of 65 and looking to put money into their super. There's also a downsizer contribution cap as well, which we can talk to you about. Market competitive fees. Look, we're just talking about some of the features of the Northern Co-op AMP Staff Super Fund. Look, there are some competitive tailored fees from being in the corporate fund as well with Northern Co-op. You may have received, AMP members would have received some notification and some communication from AMP about their simplification process. It's pretty much the consolidation of a lot of their funds over the years that they've inherited, just to go ahead and obviously make it more of a simple offer for their members, and to also go ahead and provide greater benefits and a member experience. So from 1 October of this year, you're going to find that the Northern Co-op Staff Super Fund, which was called Custom Super, is now going to be called AMP Signature Super. And there's going to be some new features and benefits, pretty much one of the larger features is the reduction in the administration fees, which I'll talk about. There's a refined investment menu. There used to be about 170 odd investments available. They're going to refine that down to just 50, which is going to provide greater leverage and scope for discounting of fees. There's also going to be access to nominating a death benefit nomination, and you can actually go ahead and do that now online from 1 October. I'll talk more about that, and you'll receive some further communication probably in the coming months leading up to 1 October or just after as well. If you wanted to talk about the simplification process, you can give us a call on how that impacts you. But one of the major impacts was obviously the reduction in fees. Now, I spoke about the glide path and the investment portfolios that you automatically go into as a default investment. Well, like I mentioned, you can go into, say, a portfolio that's relative of your decade of birth. So you've got here it's called the MySuper 1960s fund, 1970s, 80s or 90s. So these portfolios have had discounts applied to them. Investment fees, they've reduced down to 0.26% per year. They were, prior to the simplification process, 0.3%. So from 1 October, there's going to be a change there. Administration fees are 0.29% across all of those decades, all those cohorts we call them. There's also a member fee. Member fee, you pay $6.50 per month, and that's it was $7.57 per month. From 1 October, it's reducing to $6.50 per month. There's an indirect cost ratio fee, which is a fee to run the fund. That differs between the different cohorts as well. But you can see there that including your member fee plus obviously your indirect costs, you're paying for, say, if you had $50,000 balance in your super, around about $513 compared to, say, $525 per annum pre 1 October. You can see obviously the cost base on $50,000 across all of those cohorts and the savings since 1 October. Apart from accumulating money in your super through your employer or any contributions you make in your portfolio with the returns that they receive over time, there's also a insurance policy that you also receive within your super. So when you first join, you are eligible to receive death cover and also TPD insurance, which is total and permanent disability cover. So if you pass away or if you're made totally and permanently disabled and never ever able to work again in your occupation there, you receive a level of insurance cover. A level of insurance cover for death and TPD. So all employees, the amount that you receive is based on a formula, and this formula is actually an age-based formula. And you can see here that someone of the age of, say, 50 years of age, they would receive $14,000, but you can see that it's 2 times your standard insurance cover. So times that by 2, someone at the age of 50 would receive around about $28,000 worth of death cover and total and permanent disability cover, with up to a limit of $1.2 million. You've also got salary continuance insurance, which you receive automatically when you first join the fund within the first 120 days. So there's probably many of you that have joined this fund and already have this insurance cover. So this is available for full-time and part-time employees. It's not available for casuals. But salary continuance means that if you're sick or injured and unable to work for at least 90 days and a doctor prescribes that you're still unable to work, the insurance will pay you 75% of your salary, and that benefit is paid for up to a maximum of 2 years. There's also a limit of roughly how much they pay, and it's $10,000 per month. So if 75% of your salary on a monthly frequency is greater than $10,000, you're only capped at $10,000. But some great little additions to protect you and your family. Now, if you're looking at, okay, well, if you ask Travis, what do I do after 2 years when my income stops through my salary continuance, and let's say I'm never returning back to work again, you can come and talk to us about extension policies where we can look at what it would cost to go ahead and have a policy that has a 2-year waiting period on it, because it comes into force after the 2-year benefit period finishes on this policy, and can pay you till age 65 as well, or until you leave the workforce. We were talking about beneficiaries earlier, so you can now from 1 October jump online and nominate a binding death nomination. So it's important to ensure, where your super and also your death benefit goes in the event of anything happening. So you can nominate a spouse, including a de facto, and including same-sex marriages, or same-sex couples. It can go to your children who are still financially dependent on you, a legal representative, or to your estate. So if you don't have somebody who's financially dependent on you, you can go ahead and leave it to your estate, which would mean that you would have to go ahead and support that through having a will to determine which loved ones you would like to receive your assets. Available from 1 October online to nominate your beneficiary, and it's crucial that you do this because it obviously stops a lot of heartache and a lot of issues within your family who are left to go ahead and obviously deal with this, deal with your assets. Government co-contributions. So, look, if you're earning less than $41,112, and you contribute $1,000 of after-tax money into your super, the government will go ahead and give you a government co-contribution, and they will give you $500. So that's a 50% return on your $1,000 contribution. Once you earn over $41,112, they start to reduce the $500 down to eventually zero if you're earning above $56,112. So if you are earning above $56,112, you're not eligible for the government co-contribution. So it starts to taper off between that $41,000 mark up to $56,000. But it's a nice little incentive to go ahead and save some extra money into super. It's a matter of just putting away $20 per week, not via salary sacrifice, but via, say, a direct debit arrangement. So you could speak to your super provider to have that set up, to go ahead and accumulate your $1,000 per year to hopefully receive your $500 or then some throughout the year. Spouse contributions, just another incentive to go ahead and contribute to your spouse's super. Look, if your spouse is working and earning under $37,000, and if you contribute $3,000 of after-tax money, your spouse will receive a $540 tax offset, which they can use to offset their tax liability, or they might receive that as a bit of a return as well. So just an incentive to go ahead and help boost spouses that are on an income of less than $37,000. It starts to fade out as well, that tax offset, once your spouse is earning $40,000 per year. If you're wanting to learn more, look, just some engagement tools with AMP or even your own super provider. You can download their apps. They're very interactive and obviously easy to access. Or you can log into the My AMP site as well. You can and you'll receive a password and a login from AMP. When you log in, there's a wealth dashboard with AMP, which you can also add your non-AMP assets to. So it's like a bit of a portfolio hub. And it's also got, like I've mentioned, the tools and the calculators available for you to engage further with your super. There's also some webinars that are available. They're offered by AMP, which are specific just to superannuation, from understanding your investments, estate planning, getting your super on track, women in super. So there's always these little webinars that are coming out for you to access. even ourselves, look, we are financial advisors. We speak to people on a range of financial topics, not just super, but outside of super. So if you log on to our social media platforms, so there's Facebook, Instagram, and LinkedIn, and you can see that if you type in our specific name there, we've got under those logos, just follow us. And then on a weekly basis, you'll get a couple of articles appearing in your feed in relation to some topical information, anything financial. So it could be from retirement planning, tax, estate planning, mortgages, borrowing money, or anything topic specific, depending on what's happening out there in the environment of finance. So finally, we are accessible. We've got a QR code if you're wanting to book a time with us or reach out to us. We've got Kim, who supports me in the corporate team. You can reach out to her for any general queries. If you're looking for a financial planner, you can speak to myself, where I can go ahead and link you to one of our 9 practitioners. We've also got Lisa Forbes, who's our partner in the business, but she's also our home loan specialist and broker. She's phenomenal, whether it's giving you a health check on your current circumstances, doing a comparison, or if you're actually in the market for a new property or an investment property, feel free to use Lisa, and she can shop the market for you for the most competitive rates for you as well. And then there's AMP's details there as well. So look, there was a lot of information there, but I wanted to just thank you for attending today's webinar. If there's any questions, or if you'd like to book in a one-on-one, please do so when we send out your invitation for that, and we hope to see you when we're next back on site at Northern Co-op. Thanks again for your support. We're always here to help you, and all the best to you and your families. Thank you.